Okay, let's make sure I hit recording this time instead of do the entire presentation and forget to hit record. Anyways, what's up, everybody? I hope you're all doing well as we get started into the holiday season. Let's not waste time. All the disclaimers at the beginning. If you want to read, all the disclosure and legalese, feel free to do so. But, the things to keep in mind, past performance isn't indicative of future results. This is for educational purposes only. So don't make any investment decisions based on this presentation, as I don't know you personally, unless you're a client, which if you are, I love you. And let's get started by seeing what's going on in the markets and the economy. Well, after underperforming for most of the year, small cap stocks, i.e. the Russell 2000, came into their own as the best performing major equity segment in Q3. This was due to better than expected U.S. economic developments, particularly growth, consumer spending, and inflation, and falling interest rates across the board. So since these small cap stocks receive less revenues internationally, when there's positive news domestically, small caps typically perform well relative to their more internationally developed and diversified large company counterparts. The growth-heavy NASDAQ finished at the bottom of the pack, but still generated a positive return. This was due to the highly valued index taking a breather from its breakneck performance from the first two quarters. Positive sentiment was held in check as the stock market reassessed its growth expectations for the rest of the year and beyond. Finally, the S&P 500, which has a blend of older Dow Jones and sexier NASDAQ-style stocks, finished in the middle, returning around 6%. To round it out, and we'll discuss more when we discuss international stocks, the emerging markets and FE indices returned around 9% and 7.25% respectively. Now let's dive deeper into individual U.S. sector performance. Now, an unexpected, boring sector was the best performer in Q3, utilities. Now, this is a little surprising given that such a boring sector would be the best performer. However, when we dig into the fundamentals, it makes much more sense. One, utility companies are highly levered, so interest rates falling help debt burdens and reduce overall cost of capital. Two, since a lot of these companies are seen as high income value stocks, when interest rates fall, their yields look more attractive to market participants relative to fixed income securities. Simply put, their risky dividends look better than the risk-free bond and cash alternatives. Finally, many utility companies are receiving a boost in business demand due to the amount of electricity required to run emerging AI technologies. This development improves company earnings, which subsequently improves stock prices. So all of these reasons boosted demand for these steady eddies, sending the utility sector upwards in Q3. Now, the same could be said for real estate, albeit to a lesser extent, which was the second best performing sector. In addition to the reasons for why utilities performed well, sans the AI electricity demand reason, the real estate sector has also been beaten down by prior years' overbuilding and fears of overvaluation. So it's likely that market participants reevaluated their doom and gloom predictions and concluded that real estate sector is not as bad as they previously thought. At the bottom of the performance table, we have the energy sector, which can almost entirely be explained away from poor commodity pricing. WTI crude and the Henry Hub natural gas prices fell around 12% and 6.5% respectively. Obviously, when what you're selling falls in price, that's going to impact company profitability and therefore stock prices. The tech sector was the second worst performing sector, being essentially flat or returning essentially flat. As mentioned previously when discussing the NASDAQ, the tech sector took a breather after rallying significantly in the first half of the year, allowing earnings to catch up to valuations and earnings expectations. Now let's dig into individual stocks. Erie Indemnity Company, hope I said that correctly, is a plain Jane property and casualty insurance company headquartered in the Northeast. So who said you had to be an AI stock to perform well? Their momentum stems from two factors. One, a blowout Q2 earnings report, and the second and much more important factor was the announcement that their stock would be included in the S&P 500. While this seems like an odd reason to justify its high-flying performance, keep in mind that passively managed index funds now have to buy Erie to accurately reflect their S&P 500 following mandate. So a massive amount of money flowed into the stock, boosting its share price. Palantir's inclusion into the S&P 500 and subsequent rise benefited for this reason as well. Of note, Palantir is a big data AI company backed by legendary venture capitalist Peter Thiel. As mentioned in last quarter's commentary, power generation stocks are going to benefit from the increased need of electricity to run AI data centers. Unsurprisingly, GE Vernova was a beneficiary of this rise in electricity demand, like First Solar in the previous quarter. GE Vernova provides green energy options for customers, which is looked on favorably by major corporate tech buyers. Many have mandates that require a portion of their power comes from clean energy sources, with Google as one such example of a company with this mandate. In addition, analysts upgrade the stock on these positive developments, increasing sentiment for GEV and other stocks in the power generation sector. After being one of the best performers in 2024, Super Microcomputer got nearly chopped in half in Q3. The primary reason is that the company has had accounting issues, which Hindenburg, a short-selling investment company, pointed out. Hindenburg's report caused Super Microcomputer to delay their filing after they pointed out some glaring accounting red flags. If Hindenburg's history is any guide, SMCI is in trouble. To illustrate, they issued a negative report on Nikola, a clean energy big rig startup, and since then, the stock is down 99% with their founder, Trevor Milton, in jail for 4 years due to a securities and wire fraud. All of that to say, you don't want to be in Hindenburg's crosshairs, like the blimp from which their firm is named after. When they write a report on your stock, it's likely to blow up in spectacular fashion. Australia was the best performing international developed country, returning around 11% in Q3, and this can be mostly attributable to positive economic developments in the country, as their financial sector was the strongest performing sector. This points to an increase in economic activity in the country as banks and other financial institutions primarily make their money from lending money to consumers, businesses, and institutions. In addition, positive commodity performance provided tailwind as well, as zinc and aluminum rose about 5% and 4% respectively. Australia is a major exporter of metals. Japan, on the other hand, was the worst performing international developed country, only appreciating around 5% for the quarter. Japan has been grappling with interest rate issues and carry traders. A carry trade is when you borrow from a low interest rate country and then use the proceeds to invest in a high interest rate country. These traders make money by capturing the spread between the two interest rates. So to illustrate, if you could borrow at 1% and then buy into a yield yielding 4%, you'd return 3%. Because of the small returns, however, carry traders often significantly leverage their positions to generate higher returns. To illustrate the issue, Japan's markets would fall a cumulative 17% following the Bank of Japan's announcement that they were going to raise rates on July 31st. Since many traders were borrowing in Japan and investing elsewhere, this caused some panic as the interest rate they were borrowing from increased, causing the trade's profitability to fall. Add that many of these positions were levered, and that adds further fuel to the fire, which caused panic and outflows. However, that being said, Japanese stock markets would go on to recover, appreciating around 20% from July 31st onward. Now, digging into emerging markets, China was the best performing country in the emerging markets index. China has been beaten down for so long that any positive corporate or economic news spurring a rally was really inevitable. And to illustrate this, it's sort of like when your bum family member or friend does something unexpectedly positive to improve their life, and you're hopeful about their future trajectory. Well, China's the current bum in markets that have been counted out, so when they finally showed some signs of improvement, markets cheered and rewarded their company's share prices accordingly. However, concerns of escalatory U.S.-China tit-for-tat should be top of mind for investors who are thinking of jumping into Chinese stocks, especially in a U.S. presidential election year. China's major tech companies, Tencent and Alibaba, which can be thought of as the United States Facebook and Amazon, respectively, rallied significantly in Q3, returning 48% and 17% respectively. Since these two companies make up approximately a quarter of their index, their performance will drive a material portion of China's gains and losses. On the other end of the spectrum, our southern border buddies, Mexico, didn't fare too well. This was likely due to ongoing concerns regarding a far-left party gaining control of the government and the uncertainty that surrounds this development. Since markets don't like uncertainty, capital flowed out of the country, causing continued underperformance. This political development was discussed extensively in last quarter's commentary. Now moving on to fixed income markets. Yields fell across the curve, which was unsurprising given the Fed rate cut was bigger than what was previously anticipated. The markets priced in a 25 basis point cut, and the Fed delivered a 50 basis point cut. While this, on the face of it, is positive for economic growth, the underlying motivation for the rate cut is uncertain. Was it done because we're out of this persistently high inflationary environment, or because labor markets are starting to deteriorate? One is positive for the future of stock markets, and the other is much more concerning. Because of the rate cut and positive economic developments in Q2 and Q3, credit spreads generally fell across the curve, with the speculative CCC or below falling the most. The thing that makes speculative debt interesting is that it's sensitive to both interest rate expectations and economic developments. This is unlike highly rated debt that is almost solely driven by interest rate expectations. Since companies with speculative grade debt are poorly performing financially speaking and highly indebted, they'll perform well when rates are falling, and this is because of their heavy interest burdens, and an improving economy increases demand for their services, both of which decreases the perceived riskiness of these distressed businesses and subsequently decreases the credit spread, or the extra return required to lend these companies money. So to summarize, since interest rates fell across the board, securities highly sensitive to interest rates performed the best. So unsurprisingly, the Vanguard Extended Duration Treasury Fund, which is the most sensitive to interest rate movements, performed the best, returning around 10%, whereas the money market fund performed the worst, only returning about 1.25%. Now moving on to the U.S. Economy. Real GDP grew at a 0.74% rate in Q2, which annualizes to around 3%. And this is roughly in line with its year-over-year growth and long-term expectations for growth in general. The second largest contributor to growth was from the second largest GDP component, which is private domestic investment. Think of companies spending money to build factories and other long-term assets, which grew at an astounding 2% for the quarter. That's not the year, that's only the quarter. The increase in business willingness to invest was likely due to the high inflation environment coming to an end. This gives businesses a more certain environment to make investment decisions today and in the future. As alluded to earlier when discussing rate cuts, the labor market is starting to show concerning cracks. The unemployment rate increased to 4.2%, which is above 3.8% from a year ago. An increase in unemployment is typically associated with a recessionary environment, as less people with jobs leads to less income to spend on goods and services. So this development is a little concerning given that markets are near all-time highs. Unsurprisingly, given unemployment has increased, job creation is slowing, and an increase in claims for unemployment insurance really aren't a shocker. Personal income is also slowing, albeit median pay is accelerating. This could be pointed to the fact that highly compensated employees aren't receiving the pay increases that they enjoyed in previous quarters, whereas your average person is. This makes sense since a lot of large finance and technology companies have announced layoffs, likely from overstaffing during the COVID lockdown period. However, price growth is slowing, although it's slowing at a rate that is below the Fed's target of 2 to 2.5%. This makes sense given the labor market is slowing. When there is less dollars chasing goods and services, prices should slow. It's simple supply and demand dynamics at work. And finally, to round it out, the real estate market still looks a little wonky. It looks like buyers prefer new builds relative to existing home sales, which may point to the realism in new builders' home pricing versus the prices that existing home buyers are anchored to. In general, people are hesitant to sell below the top price that their property was worth or the price at which they purchased their home at, hence this anchoring bias. But if existing home buyers don't have realistic expectations for what their house is worth, home buyers will simply opt for new builds or the upgraded model, relative to a house that's been around for a while. Why pay for a used model when it's priced around what a new model is going for? Now let's see what I'm looking at as we get into the last quarter of the year. So, alluded to earlier, the unexpectedly large rate cut in September left market participants a little off kilter. The motivation for the rate cut is what matters. Is it because the inflationary fight is over, or because high interest rates are starting to take their toll in the economy? Well, the answer, it looks like, is a little bit of both. Inflation is certainly falling, but unemployment is rising and job creation is slowing. Now, Jerome Powell has stated that they are taking a month-by-month look at economic numbers when making interest rate decisions. So looking forwards, markets will be very sensitive to these economic numbers that come out between now and the end of the year. especially labor market readings. If labor markets start showing distressing signals, expect larger rate cuts. If not, expect smaller rate cuts. And if prices begin to accelerate, expect no rate cuts or possibly rates going upward. The worst case scenario is if we see inflation starting to pick up with unemployment also rising meaningfully. This would put the Fed in a pickle as it tries to navigate a stagflation environment. A stagflation environment is when we have a high unemployment, high inflation environment like we did in the 80s. Under this scenario, the market, like the Fed, will have to navigate a highly uncertain environment, which could cause a sell-off as participants rush to cash. However, I believe this case would be the least likely of all discussed, but I'm definitely watching economic reports and listening to the commentary closely. Okay, earnings reports. So what to look forward to in Q3 earnings releases? AI, of course. These stocks are still richly valued. However, it's much less of a concern than last quarter, as the sector's performance was mostly muted in Q3, allowing earnings to come in and valuations to normalize. What's going to be much more interesting in Q3 earnings are the earnings reports for companies that are sensitive to underlying economic activity. Sectors to be on the lookout for are industrials, materials, and financial industries. The major banks start reporting the week of October 7th, which could set the scene for the rest of the quarter and beyond. Also, tune into what the C-suite of these major banks say about the underlying economic conditions, as they would know how it's performing better than most. Whew. All right, so guys, that's all I have for you this quarter, and I guess I won't be seeing you until the new year. If you have any questions, please don't hesitate to reach out. If you just want to check up, see how I'm doing, I welcome all of those. And I hope you have a wonderful rest of the year. Have a wonderful holiday season. And I will see you in 2025. Later, everybody. Wish you the best.